The yuan rose on Friday, shrugging off StandardPoor's decision to lower China's credit rating, amid confidence in stable financial markets ahead of the 19th Party Congress. SP announced on Thursday it had downgraded the country's long-term sovereign credit rating to A from AA. It said the decision was based on credit factors it deemed to be weaker in China than its peers, such as lower average income, less transparency, and a more restricted flow of information. Corporate credit had come down to 166% of GDP by August 2017 from 170% in February, but credit leverage is expected to remain above 100% of GDP, according to Greater China economist Iris Pang. SP's rating cut may make foreigners more hesitant to invest in the Chinese sovereign bond market, despite the recent launch of the mainland's Bond Connect scheme, designed to attract overseas investors to buy yuan-denominated bonds via Hong Kong. China's debt problems should be well recognized by the market, Can Chung, foreign exchange strategist, Mizuho Bank. Nevertheless, onshore yuan rebounded on Friday from yesterday's three-week low as SP's action was broadly perceived as retrospective and merely a catch-up downgrade to bring it in line with the other two major rating agencies, analysts said. China's debt problems should be well recognized by the market, said Can Chung, senior Asian foreign exchange strategist at Mizuho Bank. Some RMB bears should have learned their lesson after the Moody's downgrade on China in May. Hence, the market impact was largely muted. Market participants are also refraining from selling yuan, believing that China will ensure stability in its stock, bond and currency markets at least before the 19th National People's Congress of the Communist Party of China, scheduled to start on October 18. Chinese regulators have so much control over the marketplace and the overall economy, with so many tools and levers to work with, that a lot of investors' decisions will actually be more contingent on the Chinese regulators rather than external factors, said Yuan, director of Spence Johnson, a financial data provider based in Singapore. Earlier in the day, the People's Bank of China raised the yuan's daily reference rate slightly by 6 pips to 6.5861 from 6.5867 yesterday after the dollar weakened as bet stoked by the Federal Reserve's signal that it may raise interest rates in December abated. Onshore yuan gained 0.6% to 6.5861 per dollar on Friday, set to pair its weekly decline to 0.6%. Hong Kong's dollar was also little changed on Friday after SP followed its downgrading of China by cutting the city's credit rating by one notch from AAA to AA. The currency weakened slightly to near 7.81 after the downgrade. The downgrade had little impact on the Hong Kong dollar because SP's AA rating is still the highest among the three major global credit rating agencies. Moody's has rated Hong Kong AA2, while Fitch has given it a AA score. Hong Kong's downgrade is unlikely to hurt demand for HK Exchange Fund bills EFBs substantially because hybrid rates are currently facing upside pressure due to HKMA's more aggressive action to drain liquidity and more hawkish Fed, according to Chung.